Hello traders, welcome to another video from my channel. Today we are going to have an educational video on how do I approach the market and execute my trades and where am I doing the business. Before entering into a trade, I always do these steps and consider them so that I make sure I enter in a proper area and I get the most out of a trade. Those steps are: first, understanding the market structure by marking higher time frame levels and reading price action. Second, mapping out area of value where my setup will form. Third, setup formation and entry trigger. Four, risk management and trade management. So today I will show you how I do this 4 steps before entering a trade and how you can do it also based on your strategy and way of trading. So I will start from understanding the market structure. To understand market structure, there are many ways. Some might use indicators like RSI, moving average, stochastic RSI, or many different indicators. And if you are a price action trader, you will basically use the price itself to determine uh, market structure. So, as you know that in the market we have uh, three phases like an uptrending, bullish phase, a ranging phase, which can be a distribution or accumulation, and a downtrending, decreasing phase. So these are three structures that we mostly see in the markets, and most of the time you will see the trending phases like uptrend or downtrend. So how you can understand that, is this a bullish structure? Is this a bearish structure? Are we going to continue going higher or we will dump from these prices? So this all depends on how you determine the market structure and how can perfectly you understand what's market sentiment, is it bullish or bearish. So the basic way in price action to determine market structure, you can use the higher time frame levels like daily, weekly, and even monthly, but that's not very important. So you can use weekly or daily to determine market structure and to see if it's bullish or bearish or in a ranging phase. You should see the pivot points and swing highs, swing lows, the major swing highs and swing lows. So like if we are in a bullish trend, you will see that the market makes a low and it goes makes a high, and after that it do a correction and makes another low and make another higher high and a higher low, higher high. It keeps going like this in an uptrend and it continues to break its previous high, close a daily or weekly candle above it, and make a higher low higher than the previous low. Again, it breaks the high of the previous high by making a higher high and closing a daily or weekly candle above it and making a higher low. So this is how you basically determine the market structure, by seeing if the market has broken the previous high to the upside and made a higher low, and is the market actually keep making these higher highs and higher low, so you can understand that the market is bullish. And why I say that you should consider the candle close above the previous high, because sometimes you might see fake breakouts and or wicks that go above the previous high and comes back below it. So that's not actually a break in a structure, and it might signal that the market is topping out and will not continue to go higher. So keep that in mind that a body candle close should cross this previous highs to continue a trending market, and we expect a higher low after that. Similar things happen in a bearish trend, like market keeps making lower low and lower highs by breaking the previous lows and making lower highs. So this is how you understand that the market is in a bullish trend or in a bearish trend. And it should be used on higher time frame like daily and weekly. After you understand that the market is either bullish or bearish, you can go to the second step, but always keep this in mind that you might see in an uptrend like this, you might see several price movement like this, and after that a high. So you should take the lowest low as a higher low, and you might see like this several attempts here, and after that it makes a higher low and then go up. So you take the higher high as a previous high, as a swing point or pivot point, and the lowest low as a major swing low to determine how the trend is going. And when trend becomes bearish, it must break this lowest swing low to change the market structure, not just like other unimportant swing lows, or not just by breaking other unimportant swing highs. So you take the highest high as a swing high, you take the lowest low as a swing low to determine a trend by seeing the higher time frame levels like daily and weekly. So once you have determined the market structure and, for example, you understood that the market is bullish, you should go to the second step, mapping out area of value where my setup will fall. So area of value is the place that you must be waiting for the price to reach there, so that you will get a higher risk to reward, and you should is and that's the area that you should be waiting for your setup to farm and enter into a trade. And why do we call it area of value? Because in an uptrend, area of value is the discount area that you can buy the some an asset in lower prices. So that's area of value. For example, if we are in an uptrend like this, we make a high, then we do a correction, and then we make a higher high, and again we do a correction. So this is the move: swing high, swing low, and anything below the 15% of this move is discount like this. So basically this area is area of value. And how we can determine an area of value? There are several ways, and it depends to your strategy, but I personally use range, uh, ranges, Fibonacci retracement, or order blocks to determine area of value. Like for example, in this up move, you might see some sort of accumulation on lower time frame, and you can see that it's like an order block on higher time frame. So this can basically be your area of value that you should be waiting for the price to reach here and farm your setup. Order block is one of the ways that you can get involved in the market, or you might be using ranges, like this is the swing low and this is the swing high. So where will you be doing the business? Area of value on a range is mid range or low of the range. How you will be trading it? Like if price makes a swing high and continue a trend, you will wait for the price to come to this mid-range. It might go below the mid-range, but quickly gets above it, like making a deviation or swing failure, and then making a higher high, higher low. And at this point, you'll get involved into a trade targeting the range high or possible higher higher and uptrend. So this mid range and low range can be your area of value if you're trading based on a range. Like if price do a complete correction and take the liquidity below this swing low, what you need to expect from the price to come this range low, do some sort of swing failure pattern deviation and then gets back above. So you can understand that markets uh, goal was to take the liquidity from this swing low, and then it made a deviation or fake breakout, and now you can get involved and target mid-range and high range or even a higher high. So this is how area of value is determined based on a range and order block. And the third thing you can do is using Fibonacci retracement in a trend. It doesn't matter if it's an uptrend or downtrend. Like you take the Fibonacci retracement and you can see here that 60 62% and up to 79. This whole area is a perfect zone and a discounted zone to get involved in a trend. So you should basically wait for the price to come this area, and this is called area of value based on Fibonacci levels. Once it gets here, you will wait for setup formation and other steps that I will say later on. Like price comes here and then it goes back to this high or even making a new high here. So these are three ways that you can determine area of value in a market. And in the third step is setup formation and entry trigger. Let's see, it's an uptrend and there is an order block. Price comes to this order block. You should not be blindly putting a buy limit here and placing your stop here, because the market might change its structure by going below this low, or it might not reach to your buy limit. So you must always wait for your setup formation. It depends how you trade. Like some traders I know, they wait for over under or choose to farm in the on the order block or the Fibonacci retracement levels. How does a church look like? Change of character, like price comes to here, it goes below it, it comes up, and for the second time price tries to go and make a lower low, but it takes liquidity from this low, it comes up and makes a higher high. It means that the buyers are stronger than sellers. Then it makes a higher low here, and for this uh, retest of this order block after breaking the structure or change of character, you wait for here and you get involved. So this is your entry trigger and this is your setup formation based on choice. That some might call it QM, and you might also call it based on classic um, technical analysis, head and shoulder, or any other things. Once this has formed, a retest or a higher low will be your entry with a stop below here and targeting those range highs and maybe a higher high. So this is how you do the third step. You wait for setup formation and you wait for entry trigger. So after doing these three steps, what do we do next? Oh, I forgot something else, that setup formation on a range. That's also a topic that I should say. Like you are not trading order blocks, you have draw a range here like we did previously. Let me bring the range. Yes, like this. Those who are trading ranges like trader XO, trader SC, what they do, they wait for the price to come in the mid range or the range low. If it comes to the mid range, they wait the price to go down. After going down, the price could not continue going down. It comes above this mid range. It continues consolidating and settling above this mid range. What does this mean? It means that buyers are stepping in the market and they don't let the price to go and settle below this mid-range. So once you see such a structure, you get involved around here, your stop will be this low and the market will probably go high toward this range high. That's how range traders do their business. Or they might wait for the price in case if it continues goes lower. They will wait for a swing failure or deviation around here. Price goes below this but could not close the candle. It comes quickly up. So what they do, they wait for a small correction or they directly enter to that candle close and place their stop here. As the price has did a bigger correction, their first target will be mid-range and then high of the range. So this is how range traders trade. And the fourth step you must be doing is risk management and trade management. Risk management is basically the amount you are willing to bet on a single trade. Like you want to bet 1% of your portfolio, or you want to be risking half percent of your portfolio. It depends to you, and you must learn what is the best for your strategy, what percentage of risk is the best for you, and you must do backtesting and journaling to find that out. But the another thing you must consider in the fourth step is trade management, that many might not do it, and it's very important and essential part of the trade. Like you enter into a trade, you have target and a stop, but what goes between your target and a stop is called trade management, and you must look at, like we are in an uptrend, we make a high, we make a higher low, we make a higher high, price do a correction. For example, you are a range trader, you take this swing high and this swing low, and you have entered, for example, in the mid range with a stop here. So your first trouble area, like price might face some sort of trouble to go higher, is the range high, and this is the area that you must be managing your trade. If the price could not go higher or it does a fake breakout swing failure and comes back inside the range, you must get out of your trade and reconsider entering back once price settles above the range high. So this is called trade management. If you don't do it, price might go to this first trouble area and it could not continue the trend. It just falls back to the mid range, to the area you entered, and might go all the way to the range low and take you out of the trade while you are in profit, like 1 to 3 R or 1 to 2 R. So this is how important trade management is, and you must always consider the coming supply zones in an uptrend as your area of trade management to look if the price can cross it or not. Like maybe there was some order block on here, or there was uh, hit and there was QM like left shoulder and price came down and trying to make another right, its right shoulder. So you must consider this supply zone order block or the range high and other resistance area as the area that price might not cross it. So you must be watching. If it couldn't, you should get out of the trade and manage your trade, or at least close 50% of your trade, and or you might bring your entry to the your stop loss to the entry. But I do not suggest it. You should get 50% off the board, or you should be closing your trade and wait if the price could break it and get back involved into that trade. This is called trade management. So I might in the coming videos talk more about trade management, risk management, about evolving R or evolving risk, and many other topics. So stay tuned and wait for my other videos. Let's do another, let's do this all steps into an example. As you can see that this is Litecoin USDT. So I'm going to do how I do these four steps while I'm trading. So you can see an example of these steps happening. So as you can see that we are in a downtrend, let's go to the, let me remove this, go to the, okay, we are on the weekly chart. You can see that we are in a downtrend. Uh, since this high, we made a low, we did a correction, we made another low, and keep making lower low and lower highs. So we are in a higher time frame downtrend, and it can be seen even on the daily chart. But here you can see that this is called a ranging phase, that we have been inside it for several months and for several weeks. So we are somehow getting out of this range by making a higher high here and maybe a higher low. So this is on daily chart, and on monthly and weekly, if the price even goes to these areas, we can be still bearish, in a bearish trend according to higher time frame like monthly and weekly. But in lower time frames like daily and 4 hour, we can turn from the downtrend into accumulation phase and into a bullish trend. So I will start from monthly chart by marking higher time frame levels. I take this down candle before this up move on the monthly, and here price came down and did a correction. So this low is looks important, and price has reacted several times to it. And before this rally to the upside, I take this this 1 month candle, down candle before this up move. You can see that this order block, after price moved up, it retested it and rallied to the upside, and now it's doing around it retest on here. So it's an important support zone. And to determine my trading range, I will take this monthly candle. So this three. And now we go to the weekly, if we can find some other important levels. Okay, now we go to the weekly chart. So in weekly, there isn't anything special to mark out. You can see that there was imbalance and the next area can be here. But as long as we are holding this high, let me mark it up. We could not close a weekly candle above it. We are still in a downtrend. Why? Because this was swing high and this swing low. So price can be ranging inside this area and make another low right around here. So we are still in a bearish trend on the weekly and monthly, but on the daily we might be bullish and we might do some uptrend move, which will be a correction on higher time frame like weekly. So now we go to the daily. You can see that the market structure on daily and 4 hour has changed. We were in a downtrend. We made a low and we went into a ranging phase, accumulation phase. Now we had closed a daily candle above this swing high before this swing low. So the market structure somehow has changed and we are holding this range high and it's highly probable that we go towards this weekly level and this daily order block. So you can take this daily order block as well. So now we understood that higher time frame trend is bearish, lower time frame than daily is in an uptrend. It was in an accumulation phase, now it's in an uptrend. So as long as this area holds this order block, why? Because this was the swing low before the swing high. We are in a bullish trend up to this supply zones and we have broken this range. So this is now our area of value, first area of value, this second, and this mid-range can be also another area of value that the price can come to it and go higher. So to backtest it, I will use this replay bar. From this low we will do a, so this is, so on the daily you can see that this was swing low before this swing high. So the price, this area accumulation must hold the price, or if the price comes and takes this swing low but makes a swing failure, price can still continue to to make a higher high. So now we take that, we go to the 4 hour chart and you can see that in an hourly price has made a swing failure below the swing low. So according to SFP or deviation, as you, if you got this as range low and range high, let me mark it up, like this one is range low and this is range high, so you can target this area. I will remove it again. Okay, we take this swing low and this swing high, and to determine the mid-range I will use this. Okay, so now we have the mid-range. What does this mean? It means that we took the swing low and we made a swing failure. So first target can be this, second target can be this range high, and maybe a higher high. So we take it as a mid-range. So now we have marked, understood that was how is the market structure on higher time frame is bearish, on lower time frame is somehow bullish, and now we have marked our area of value, like it was this zone before that up move and also this low. So price came and took that low, made, made a deviation or swing failure. So we have, like, for example, after this swing, this candle closed above this low, it means that's a swing failure, so you get your first entry according to swing failure here at this low. You place your stop below it and you enter here. First target here, second target this swing high. So it's your first entry. Let's play the. So you, as we discussed, step two was determining area of value, that this swing low is area of value, and we wait for setup formation. Setup was swing failure and candle close above this swing low, so price did that. And now we are entering here and we might uh, determine, like, I am risking 1% on this trade, and areas that I should manage my trade, do trade management, is this mid range and this high of the range. So now let's play it and see how the price goes. Okay, now you can see that price has made a higher high above this. So after this swing low, we also broke the structure and we are to this mid range, and you can see that the price is strong. You can take 50% off on this and let the position open. But before, let's see if we didn't long this swing failure, where can we get another area of value. You can see this down move caused by this hourly order block, and it got retested and price went up. So if price comes for the second time at this area, you can enter into that and stop, place your stop like below this area. Let's play it forward. Okay, price tagged to that area and it's now breaking the structure based on change of character happened here. Now we wait for the price to tag this order block to get involved. So let's place our buy limit here. Oh, sorry. At this order block with an stop below it, targeting the range or swing high. So now let's play the price forward. You can see we tagged in with the stop at here. Price continues to go. So now that we are again above this mid range, we might still take another trade at this mid range. Let's see if it happens. So we go to an 4 hour chart now. And play the price forward. You can see what the price did. Price came to this mid range, retested it. It went below but could not come lower and got back above it and claim it. So if the price comes to this area, you can long it with a stop below this area. Let's see if it comes. Now that we also see what are the possible next targets, we go to the daily first. You can see that on the daily there's an up candle before this down move, so this can be also taken as a supply zone. Make the color red. So the next target can basically be somewhere between in the middle of this order block. So that is 79 or 78, yes. Now we go back to the 4 hour. You can see that the market tagged this area. And now we go to the 1 hour chart to see if the price does some sort of rejection. We take this low. If price comes below it, price might do a bigger correction. So if you didn't got out of your trade at this target, you will wait after the break and close below this level. Okay, so the price got below this, and now you can expect that the price go lower to this area or even to this accumulation area. So you get out of your trade here. And now let's go to the 4 hour. So this last part was trade management into this supply zone. As the price came below it, you take out or you target this supply zone. So I hope you understood that how I do these 4 steps: determining market structure, area of value, waiting for setup formation and entry trigger, and then risk management and trade management. Thanks for watching this video. I hope to have a great week.